good afternoon, everybody. My name is Len Lonzi. I am the Managing Director of the Preccelerator program here in Santa Monica, California. We're a program of a law firm, Stubbs, Alderton, and Marklees, a full-service tech-focused law firm. We have full services from litigation to transactional, and we are happy to have a program that serves this ecosystem for tech startups. Our Preccelerator program was born in 2012, and here we are 49 companies later. And today I'm very, very excited to introduce our presenter for a couple of reasons. Jeremy and I have become good friends over the past years. Jeremy came to the Preccelerator probably 5 years ago, I think.
Sounds about right, though.
As a CEO founder of a IoT focused company. And he has since moved on from that company, moved back to North Carolina, where he's originally from, and started a new company called GoalMakers. And in that context today, we are going to hear from Jeremy and really get down to some brass tacks and really how to understand financials and financial literacy. April is Financial Literacy Month nationally. So this is a good follow-up to our program on financial modeling 2 weeks ago. And with that, I will let Jeremy continue with any self-introduction he would like to make, and welcome everybody. Please mute yourself during the presentation. This presentation is being recorded, just so you know that, and we will have the recording up probably in a couple of days after we do some post-production on it. So with that, without further ado, Jeremy Wall.
Wonderful. Thank you, Lynn. And it is really awesome for me to be on the other side of the mentor table. As mentioned, I was a founder in the originally, I think it was 2016. I mean, time flies, but 2016-17 class. The community, I've stayed friends with my cohort. It was a wonderful program. We had the farewell for Heidi a few weeks ago, but even though I'm on the other side of the country, it's wonderful to be part of this amazing community that honestly keeps on growing every day, and it's really impressive. There are mentors like Paul, who's on the call, who were there helping me grow my first company. And so it's exciting to be on the other side. And really with that, I know that we have a former CFO, Megan, on the call. So there's a little extra bit of pressure for me to nail this. But with a quick bit of introduction on myself, the previous company I started was called Luminous. It was an IoT company focused on bicycle safety. Our first product launched last year, and it was called the IO Light. It was, as we like to talk about, the world's smartest bike light. In that process, we raised money from a few different investors, including a Taiwanese strategic partner. And one thing that along the entire path of my journey, I did a handful of incubators, both in LA, San Diego, and San Francisco. There were certain things that I just never fully understood. A lot of that was on the financial side, and a good bit of it was also on the management side, how to work with people and how to really be a good project manager and people manager in general. And so that is what inspired this kind of transition to GoalMakers. For a bit of context on GoalMakers, 2 years ago, a good friend of mine, a fellow entrepreneur, he invited me up to Bend, Oregon to see a program called the 5-Day MBA. The 5-Day MBA was an intense seminar where it was actually broken up into 2.5 days. You flew home and then 2 months later flew back because they said it would be too much and your brain would turn to mush if you sat there and listened for 5 days straight. So the 5-Day MBA focused on financial literacy and management skills and all these items that I really lacked. After the first 2.5 days, I was hooked. I was in love with the material. And I actually reached out to the instructor and the facilitator. He had written a book called The Winning Manager's Playbook. He had created the 5-Day MBA and put probably 200 people through this intense program. And I asked him, John, really, what's your plan for expanding this? And he said, I'm retiring. And that was an opportunity that I immediately saw to say, this material should not disappear just because John can't do the in-person seminar anymore. And so that began a long process of me and my now co-founder, Nicholas, taking on all of the intellectual property from GoalMakers Business Consulting. GoalMakers had been coaching their clients for 30 years. On top of that, they had written the book, they had done the 5-day MBA. And so we partnered with John. He is now our Chief Curriculum Officer. So what you'll see me present in about a minute is really focused on his material. And so with that, I will add the caveat that I am not perfect at any of this. I am still a founder who is learning every step of the way how to track these metrics that matter, how to implement the management skills that I teach. But as someone who's drank the Kool-Aid pretty hard, at this point, I'm now kind of stepping into this teacher role. But what we've created is a digital version. So instead of the 5-day MBA, we have launched what we call the 90-day MBA. And so this is a presentation specifically created for the Preccelerator program, but it mimics a few of the elements in our financial literacy part of the course. So with that, I've given a little background on GoalMakers, but the 90-day MBA takes all of the lessons from the book as well as the lessons from the 5-day MBA and made it digital. With that, we've added a few interactive tools. So it's not just watch a video, read a page, watch a video, read a page. It really starts with the first thing that we start with is vision. And so creating that vision is the long-term 5-year out plan. And instead of saying, here's the 5 parts of a vision, it coaches you through and actually helps you implement that. But the back half of the program is all focused on financial literacy. And that's where I'll just scratch the surface today. And so today, it's kind of broken up into 3 parts. The first part is essential for us to do the second 2 parts, and it is an overview of the balance sheet and income statement. In order to track your metrics, you need to have these 2 super important financial documents figured out. They are not difficult, but often people say, wow, that's a whole new spreadsheet that I've never looked at before. And especially founders like myself who didn't have a technical or didn't have a business background. I had a fashion product development background. I went to the College of Textiles. I did not study these fundamental business techniques. And so these are things that everyone should know. And beyond that, we'll then go into the financial ratios. So we'll pick out certain numbers from the balance sheet and the income statement, and we'll look at those in a different light of saying, okay, we've got these separated numbers. How do these numbers, when calculated together, provide ratios that allow me to track the future of my company? Where are we at on these different pieces? And so the title of this talk is called Metrics That Matter. We're going to dive into just 3 of them. There are 15 in total that I'll present, but we're going to really do a case study where we have a fictitious balance sheet and income statement for 3 years for a company. We'll really just say, let's focus on 3 of these. I specifically picked 3 that I think resonate a bit more with startups and companies that would be within the Preccelerator program. So for example, inventory is something that most modern day tech-related companies don't deal with, but there are some super important pieces of financial literacy that deal with inventory. So we'll focus on just 3 of those within the realm of the financial ratios. If at any point you have questions, if something I say doesn't make sense, if you just have commentary, Megan, you know more about this than I do. So if there's something I missed or skipped over or said wrong, please drop it in the chat and we'll address it. And that'll be a way to make this a bit more interactive. So the first thing that I have to say is most people say, why am I learning this? That's the accountant's job. I pay someone else so that I don't have to do this. That is the absolute worst mentality that a startup founder can have. It is your job. It is everyone's job. Essentially, what I like to say is that if every employee at your company had a better understanding of the finances, everyone, and the term that we've used from our founder, John Chaffee, is from the sweeper to the CEO. If you have a factory floor, the person who is cleaning up the halls, if they understand return on investment, if they understand accounts receivable, if they understand gross margin, you will have a better business. And that is not just me talking out of the side of my head. That's real. The idea that everyone should understand these metrics is something that I think really is fundamental. So, and as Karen just pointed out, it's not fun to not understand this stuff. And personally with Luminous, I experienced this. I said, wow, the balance sheet, yeah, let the bookkeeper take care of that. But because of that, there were certain decisions that were made that put the company in dire financial situations that it never should have been in. It never had to be at that position. And so the goal of this, by no means am I as financially in depth as Mark Wald on all of these. I know he gave a great presentation last 2 weeks ago, but the first step is let's just talk about these two fundamental financial documents. First is the income statement. The income statement in its simplest form is a snapshot of a period of time. So you can do an income statement from, usually it's viewed yearly. You can break that down into quarterly. Anything less than that, it's probably just not worth as much work as it is. But you could even make an income statement for a 4-hour window of time. That is how flexible the income statement is. In contrast with the balance sheet, which is everything to date of your company, the income statement is a bit more of a way to track how you're trending. And so I think that's why I like to say the income statement is really important, but it's like a point on a ruler. If you don't understand where you're at last year or where your goal is to be next year, this document feels a little bit less helpful standalone. It's an incredibly helpful document, but tracking that year-to-year trending, that's what your job is as a founder. That's where as a CEO, you really need to step up and take the responsibility of saying, okay, here's where we want to be 5 years from now. What are the metrics that we need to track in order to get there? And then the only other part that I'll focus on the income statement, we'll look at one in a second, but the only thing I want to highlight, there are a bunch of numbers on this. There is a reason that people say focus on the bottom line. It is very literal. The top line is where your revenue is. And revenue can be a big shiny number. Revenue can continue to go up every year. But if your net profit after tax does not go up, you are not going to have a successful company. Again, I add the caveat that this is for startups. Some people, Uber, Snapchat, WeWork, they don't focus on the bottom line. WeWork paid for it. Other companies, they have different metrics of success. It's user numbers. But for the average company, for the average person who's listening to me talk, for my own experience, if you focus on revenues alone, you will run out of cash because you're not focused on your net profit after tax. And so that is something to have a sustainable growth pattern for your business. Look at the bottom line. Here is an example of a company we all know, Apple, and this is public as a publicly traded company. You look at this, you say, oh, 229,000. That is in millions. So 229 million, it is a different ballpark, but I think the fun thing about taking this and saying it's in millions is this is more realistic in terms of the numbers for the average company when you break it down into the 100,000s. This is a publicly traded company, and this is what their income statement looks like. It is all the same lines, no matter what type of company you are. You might add a few here or there just to be more detailed. The one that we'll use in our case study later is from a case study within the 90-day MBA called Voila Rock and Tile. And so you'll see they hire direct labor, subcontractors, and they have a big material cost because it is a rock and tile corporation. Materials are more expensive. And then if someone can just confirm, can you see the blue dot on my screen as I move my cursor?
Yes, sure.
Perfect. So revenues, again, big number up top. Big number keeps growing every year. But as you can look at the bottom line, and I know it's kind of cut off here, this number can go down even though your revenues go up. And I think that that's something that when we talk about metrics that matter, your net profit before and after taxes is something to keep your focus on. A lot of the times you say, oh, we're growing sales, awesome, up and to the right. Your revenue can go up and to the right where your net profit goes down. And I think that's something that often as founders, we forget about, that net profit is the number you need to be looking at. And then there's gross profit. I mean, on top of this, you often, famously, Amazon was reported their profits frequently and be blown away, but they would say profit. They wouldn't necessarily specify, was that before net profit or was that gross profit? And as you can see, there can be a big difference in those numbers. So with that being said, next we go to the balance sheet. This is a holistic look at the business since it was formed and it began. We talk about this as the life cycle of the business. So it's called a balance sheet because it must balance. So it is your total liabilities plus your net worth. and I use the term shareholders equity. That's more of a Canadian term, but it is the same thing as net worth. Your shareholders equity, it's a little bit more of a realistic term because as the shareholders, you all share a percentage of this net worth. So that's the term you'll hear me use in the formulas later. But net worth is the more common term. Your assets equal your liabilities plus equity. It's that simple, and that's what needs to balance. There are certain times that I, even in Luminous's early days, said, yeah, here's the balance sheet. I submitted it to my shareholders and they said, this doesn't balance. And that was a real problem. So again, we're not going to dive into these too deep, but this is something that founders need to be aware of. So current versus fixed assets. Current just means that it's intended to be turned into cash within a year. Fixed assets either will never be turned into cash or are much more long-term. And as you look at the balance sheet, the most liquid numbers are at the top. So cash and cash equivalents, securities, then accounts receivable. Accounts receivable is the payments due to you from the people you work with, whether those are your customers or any other sort of receivables that you might have out there. You can see that it is from top to bottom, the most liquid at the top. Again, I used Apple because this is a company that we can all look at and say, wow, even Apple as a $1 trillion company can still say they break down their entire business into this one sheet. And it's that simple. Like I said, we'll use Voila. And so Voila, Rock and Tile, we have 3 years here. And with these 3 years, it's the same thing that we just looked at with Apple. It is not different for a small company or a big company. You might just see some new lines in here where Apple's not going to put yard equipment. There are certainly the same pieces of this, but at the end of the day, your total assets needs to balance with your total liabilities and shareholders' equity. Total shareholders' equity is the net worth line. If that is confusing, I will point it out every time. But net worth, total shareholders' equity, the same thing. This and this must balance. So, quick pause. If you don't understand these two items first, this is really the fundamentals. These 2 documents and then a statement of cash flows are the only 3 documents that you're really going to need to fundamentally understand. In the 90-day MBA, we break it all down. We make it a little simpler. We have a whole section on both of these different items. That being said, that's not the focus of today's conversation. But refocusing this, it is not the accountant's job. It is part of their job, but it is also your job to look at these financial ratios. This is how you know if your company is trending in the right direction. These can be calculated at any point. They are not difficult, but they start with having these 2 documents in place. So if you have these 2 documents in place, then this next part's going to be easy. And honestly, a lot of founders just don't have an income statement or a balance sheet in front of them. Maybe the company's not been around a full year. Like I said, you can make these from any statement of time. So it could be your balance sheet from if you started a month ago, you should have a balance sheet. The financial ratios. What I'm going to show you are universally known. This is not something that Jeremy Wall and GoalMakers has created proprietary. These are common language ratios. And they're universally known in finance, and now it's time for you to understand them as well. So the 4 big buckets that we're going to break this down into, and again, we'll calculate a handful of these for Voila. So the 4 big buckets here, we're going to start with the balance sheet. You get your current and your quick ratios. The whole focus here is, can you be liquid? As you can see, your current assets divided by your liabilities. There's a lot of assets. This could include land, but that's not a quick turn into cash. And so there's certain things that are much more quickly turned into cash, and that is either A, cash and cash equivalents. Cash equivalents could be a note or any sort of CD. Well, some of those have limitations, but there are cash and cash equivalents plus your accounts receivable, the money that your vendors owe you. That's your quick ratio. That means what can you turn into cash immediately? These are the kind of things that your banker is going to ask you. If you are going to raise money and you have a savvy investor, they might ask you, what's your current ratio? If you can't answer that question, not to say that you're a bad founder, but that's an immediate demerit. when someone who is a professional investor is asking you what they think are pretty basic questions. So that's why, whether you're starting up early and saying, oh, this isn't important to me, we're just trying to grow the business, this is all, we're using traction and numbers, these are the kind of things that you will be asked throughout your career. And if you're raising money and you don't know these, it will hurt you. Then we go into the income statement. That's your gross margin and your net margin. Beyond that, we look at efficiency ratios. This is where there's both general efficiency ratios, so a much larger kind of pool of your asset base. Then there are current financial ratios. These are the things that you really would be able to turn into cash within a year. So within that, this is where we're going to focus a bit more. We will break down AR turnover and AR turn days. We will look at return on investment because that's as basic as it is, something that I think every founder should know. And then we'll also calculate a current ratio for Walla Rock and Tile. So with that, we're going to say there's kind of 3 reasons to do this. First, you just need to understand them. Like I said, investors will ask you about these, and there are certain numbers that investors are looking for. Oftentimes, you're looking for a 2-to-1 current ratio. They're lower and higher depending on the industry you're in. If you are in landscaping, your current ratio is going to be a little bit more tied up in stuff that's not liquid. You're not going to immediately sell your truck and your mower versus a company that has a ton of inventory. So these metrics are standardized by industry. So you can even go look up what is my industry as a SaaS company or as an HR company or as a consulting company. What are our kind of standardized metrics of success? And then you can use that as a barometer for your own company. Every business stage is going to be different. So if you're a startup, you might not be very liquid compared to a company like Apple that is sitting on tons of cash reserves. And so it's important to just understand these. Fundamentally, at the baseline, understand them. Beyond that, it's super important to be able to use them to actually calculate what you've got here. So having your financial statements, I will send out, and Lynn can drop this in a resource base. I will send out this list of the financial ratios so you can see all of them. It is simple to calculate, and it's something that every owner should be able to do. If you have the simple income statement, balance sheet in front of you, you can do any of these at any given time. And then the third part of this, and as you might have picked up on this, goals is important for my company and how we work with customers or partners. If you don't create goals for these ratios, you're just kind of flying. And so by creating these goals, what do you want this ratio to be? You're actually gonna have a way to calculate your success. It's as simple as we break it down that accomplishing goals is a definition of success. There are plenty of definitions of success, but by creating your goal and then achieving it, it's one of the most baseline versions of that. And so if you understand them, you understand how to use them, then you'll be able to create, while maybe ambitious, realistic goals for these financial ratios. So the 3 that we're going to dive into, and I am actually going to force everyone on this call to calculate them on your own. So if you have a piece of paper, a Post-it note, or just your phone and a calculator, I would suggest grabbing that now. We will look at the current ratio, accounts receivable turn days, and then return on investment. The current ratio. So starting here, and this is a simple definition that I will read off the screen. A liquidity ratio that measures a company's ability to pay short-term obligations. Current means within a year, so short-term obligations due within 1 year. Showing how an organization can maximize their current assets on its balance sheet to satisfy its current debt and other payables. I've got some takeaways about what you kind of would look for on this. As mentioned, industry standard is somewhere between 1.5 to 3. And that's a ratio, so it's 3 to 1. But this is something that if you go to get a loan from the bank, they'll ask you these kind of questions because they want to know, what's your liquidity? If shit hits the fan, sorry, I don't know if I can say that. If stuff hits the fan in terms of your business, or COVID happens and you don't have a liquidity ratio that's higher than 1.5, it's very hard for a bank to say, we'll give you money, because they just know that it's going to take longer than a year to turn this into cash. So it's going to take them longer than a year to even get that. And if you look at inventory, selling through inventory, while that's in the current ratio, that doesn't happen overnight. Accounts receivable, that doesn't happen overnight. These are things that if your average inventory turnover, say inventory sits for 90 days, 3 months before you sell it, and then on top of that, you have a 60-day payment window, it's 150 days to turn that into cash. And those are considered your current assets. So those are the things that are most liquid, and that's not very liquid, 150 days. So that's why this important ratio exists. As simple as it is current assets divided by current liabilities. All you need is the balance sheet, and I'm gonna pause for 30 seconds to allow you to find on this document right here, current assets and divide by current liabilities, and calculate this yourself. If you have any questions, feel free to drop them in the chat. All right, this is a super simple one in the grand scheme of the ratios. Anyone want to just hop off mute and throw out a number?
2.
Ooh, awesome. So this is where those numbers are. Total current assets. And sorry, I definitely should have pointed this out. My apologies. I was saying to calculate for 2017. There are 3 different current assets on there. My apologies, I didn't point out for 2017. Just it's easier to find those numbers. Total current assets, 1,443,811. Total current liabilities, 552,213. So that means that their current ratio is 2.615. So round that off, 2.6 to 1. Does anyone want to take a stab at turning that into a sentence that actually makes sense in English to us normal people? Anybody?
Have 2.6, what's the sentence I'm trying to say? You have more assets than you have liabilities, so you're able to pay them. How about that?
At the simplest level, yes. For every dollar of current liabilities, we have $2.60 in current assets.
Well, that's a good way. Yeah.
And so just to kind of return to this previous slide, for every dollar in liabilities, we have $2.60 in current assets. And as mentioned, 2.6 is a pretty good ratio. At the end of the day, if you had a run and you really needed to pay out a ton of money, there's nothing at this $552,000 that you would be super worried about. At the end of the day, you only have $44,000 in cash. So you could pay that off quickly. That's what's in the bank. As you can see, Carmine has a ton of inventory. Voila has a ton of inventory and a ton of accounts receivable. So the accounts receivable, maybe they have a 60-day payment window. If that's the case, between this number and this, you're almost paid off entirely on your current liabilities. If you can flip some inventory, maybe you can do it in 3 months. It depends. But this is where for every dollar of current liabilities, we have $2.60 in current assets. If you think about this fundamentally as a business owner, this is something that an investor would ask you. This is something that a shareholder or a banker will really say, I need to know this information. And if you, as the founder, as the CEO, I don't care if your accountant can tell me this number. If you as the CEO can't give me this number pretty quickly within 10 minutes, if I ask you, The average CEO doesn't have this number on the tip of their tongue, but it's something that if you can answer this question and you can answer confidently, that is more, I personally think that is more impressive to be able to answer this number, even if it's not an impressive number. The fact you're aware of that, that's a metric that matters. If you're at 90 cents in assets for every current liability, you're in the hole, but you can answer that question immediately. That shows that you're paying attention to the books. That shows an investor or a banker or a accelerator who may be looking to let you in that you have your stuff together, even if you know that it's not where you want it to be. And so this is where setting those goals is super important. If your business can calculate this and you're at 1.5, it's on the low end of kind of acceptable, but it's still acceptable. Set the goal. We want to be at 2.0. We want $2 in assets for every dollar in liabilities. Those are the kind of goals that are super important to set, because then you have a target to work towards. If you don't know these numbers, you can't set that goal in the first place. The next big one. This is personally one of my favorites. I get it that accounts receivable feels silly, but it's something that you can make a big difference in your bottom line, and an even bigger difference in this number right here if you can get your accounts receivable under control. A lot of businesses just can't do it. Whether it's a problem with conflict and saying, hey, this person hasn't paid us, we have a 60-day window, it's now day 61, what do we do? I don't want to piss off my vendor or my partner or these are the things that you need to be able to understand, because if you can bump this up and say, our goal is to make our accounts receivable days shorter, you'll see how that affects the cash flow situation of your company. And at the end of the day, a lot of these numbers come back to your cash flows. And when you have that cash in the bank, so you can pay out commissions to those you have to pay. So accounts receivable turnover, there's actually two parts to this equation. But first, the accounts receivable turnover ratio is used to quantify a company's effectiveness in collecting its accounts receivable, otherwise known as the money that is owed to them by customers and clients. This ratio measures how well a company uses and manages the credit it extends to customers and how quickly that short-term debt is collected or is paid. A firm that is efficient at collecting on its payments due will have a higher accounts receivable turnover ratio. So if you're efficient, this number is higher. You want this number to be higher. That being said, there's a caveat to that as well. If this number is too high, you are not giving your partners credit. And you may be scaring off customers or clients because they really want to say, hey, I need 30 days. I need a little more time. And there's a whole other conversation on accounts receivable and how often you extend discounts based on that. That's a different conversation. But the fundamental level is how well can you collect this money from your people? So on this one, you need both the balance sheet and the income statement. I'm going to pause for T-minus 30 seconds to let you find the sales. Hint, sales is revenues. It's just another term for revenues.
And just to be clear, we're doing that for 2017.
Yes, thank you, Lynn.
Because I did 2019 as an overachiever.
You can do all three of them if you'd like. Well, not on this one. I cut it down, but
yes, you did. So sales over accounts receivable.
As a reminder, if you haven't found accounts receivable, it is one of your more liquid assets. So it means it's towards the top of the balance sheet.
So, Jeremy, when you're doing this calculation, are you doing this before you take the cost of goods out?
Yes. Yes. So you're actually going to do this.
Total revenue line, top line.
Mm-hmm.
Okay.
Mm-hmm. Good question. So revenue is here. Accounts receivable is here. Has anyone calculated a number?
7.28.
Beautiful. So pointing to those numbers again, accounts receivable is $474,100. Your revenue for the year is $3,450,500. If you calculate that, your accounts receivable turnover ratio is 7.3 to 1. Now, if you can make this into a sentence, kudos on you. At the end of the day, even if you can make it a sentence, that sentence doesn't really make sense. And so that's why we have accounts receivable turn days. So instead of making this a sentence, we turn it into days. So just to read this off, the ratio can be used to measure how many times a company's receivables are converted to cash in a given period. The receivable turn days is calculated annually, quarterly, or monthly. So a company's receivable turnover ratio should be monitored and tracked to determine if a trend or pattern is developing over time. Companies can track and correlate the collection of receivables to earnings to measure the impact of the company's credit practices on profitability. If that doesn't make sense to anyone, in layman's terms, we just calculated this number. Now we're going to use that and say, okay, let's divide that number into 30 days for monthly, 90 days quarterly, or 365 for annually. Once you have this number of what your accounts receivable turn days is, it's important to now track that. And if you change these numbers, maybe you say, let's try and break down and give new accounts a 45-day collection period as opposed to what we had done in 60. Now you can start to really see how those changes are affecting your business in terms of how you extend credit to customers. So we calculated our AR turnover, 7.3. Whoop, I did not change that number. I apologize. I changed it down here. 7.3, we're going to get it for the year. And so 365 divided by 7.3 is equal to 50. Now, does anyone want to take a stab at turning that into a sentence?
Every 50 days, your AR turns.
On average, which is important, it takes us 50 days to collect our accounts receivable.
Okay.
So on average, it takes us 50 days to collect our accounts receivable. One thing that I note, there's an asterisk and an underline and a secondary note. Averages can be deceiving. For example, if you do business with Walmart and Walmart is your largest account and Walmart accounts for 65% of all of your receivables, but Walmart is automated and has stacks of cash, they pay you on the 30-day mark every single time. There's not a problem with that. Walmart is bringing your average down, but your other vendors, your customers, might take a really long time to pay. So while this number is helpful in terms of tracking metrics that matter, it's not alone in terms of understanding that that's an average across the board. But if you took Walmart out, maybe this jumps up to 70 days. So it's one thing to be careful on. All these ratios are averages. But you could also do this same thing where you could take 365 and find out per quarter how likely it is to turn. And so instead of 365, you use 90 days. You can use a month. In terms of your turnover on receiving your credit from those you extend it to. So this is one that I think is super important. A lot of people struggle to comprehend this, but if you can make a change in a 2-year period, you can say, let's get this number from 50 days to 40 days. I'm saying a 2-year period. That is a long time to try and say, hey, we're changing our credit policy. We're now making sure that we get people to pay on time. Someone's job becomes really badgering those people who don't pay. This is the difference of hundreds of thousands of dollars in cash on hand. I know that sounds silly, but if you come back here and you look at accounts receivable, for a company of this size, that could be a third of your entire asset base broken down here. And so it's something to remember that difference of 10 days really is not something to just shrug off and say, I'll get my money later. That is really where this begins to affect your cash flows. And when that money is in your bank, could be a big difference of when you actually need to pay it off. And then finally,
Jeremy,
yes.
Jeremy, you may have said this is Paul, but your turnover also needs to be considered in relation to what your normal terms are.
Yes,
If your normal terms are 60 days, 50 days is awesome.
exactly.
If terms are due on receipt or 15 or 30 days, 50 may not be great.
Yes. And so just to kind of emphasize what Paul said, I think that's a super important point. Thank you. Thank you for that. If you have a 60-day kind of average, if you say, hey, we collect in net 60 and you're at 50 days, you're doing great. You're kicking ass. You're knocking it out of the park. But if your extended credit is, hey, we operate on a net 30, but you can't collect that hit from those accounts and you struggle to get them to pay on time, 50 days is really a problem. So I think that's super important what Paul pointed out. Every business has different term limits as well. I mean, if you're there's certain companies that don't even have accounts receivable. I think that's another thing to point out. Not every company is going to have accounts receivable. An example would be an insurance provider. They actually get paid ahead of time. It is the opposite problem. So there are plenty of companies that have different metrics here. 50 days, I think this is where it's also helpful to look at these ratios is you can Google industry standard, fill in the blank for your industry on these type of numbers, and it'll usually give you a good ballpark. At the end of the day, maybe you really love working with your customers and you want to be flexible, and this is what saves your company and makes you a differentiator. You offer better credit terms. This is the kind of stuff that every business is different, but if you can't give me as an investor or me as a partner and me as a shareholder or even your employees who are in charge of collecting receivables, if you cannot give them or they cannot provide this number for you, that's a problem. And I think that's one of those things that I say this as the pot calling the kettle black. Like, these were not numbers I knew with Luminous, not even the slightest. And so the reason that I'm so passionate about this is that these are the kind of numbers that just help you track, are we in the right direction? Are we moving towards the goals we've set? Have we even set a goal? What our AR turn days should be? So it's not always necessarily easy to have the standard of what that should be, but being able to track this over time is really what helps standout businesses succeed. Thank you, Paul. So the last one we'll touch here, it's simple. Everyone has heard it, ROI, return on investment. And I think everyone looks at return on investment in many different ways, but when you talk about it from a shareholder's equity standpoint, the return on investment is a performance measure used to evaluate the efficiency or profitability of an investment, or compare the efficiency of a number of different investments. ROI tries to directly measure the amount of return on a particular investment relative to the investment's cost. To calculate ROI, the benefit or return of that investment is divided by the cost of the investment. The result is expressed as a percentage or a ratio. So as you look at going to raise money, as you go talk to angels and VCs and incubators or friends and family, you're gonna talk to your rich uncle and ask him for some money. These are the numbers they want to know. And your uncle who's not that rich, but gave you $10,000 to start and owns 0.25% of your company, they should know these numbers. And so a quick one, let's calculate for 2017, what is the return on investment in the year 2017 for Waller Rock and Tile's shareholders? Pointing out, shareholders' equity is the same thing as net worth. I'll just point to it already. It's not a race, but whenever you've got it, holler it out.
As fast as I can type.
Anybody?
0.21.
Beautiful. So the one thing to point out is that this gives you that 0.21 number. This is going to be expressed as a percentage, usually, or a ratio. So does anyone know how to make that into a sentence or want to take a shot at it? This is the hard part. I'll be honest. These numbers are good, but then expressing it in a sentence is another really important part of this. For every blank, there is blank.
I can give it a quick shot.
Please, John.
For every dollar invested in the company generates $1.20 for its shareholders.
Close, but it's for every dollar you get 21 cents back.
Yeah, makes sense.
Yep. So 21% of every dollar, 21 cents. It's a nice thing about percentages and dollars. For every dollar I put into this company, in 2017, I got 21 cents back. And so if you do that for 5 years, that's good. And that's the kind of ratio there. That being said, there's a whole other conversation of this number changes year over year. And while the shareholders' equity grows in this company, you're not necessarily paying out a dividend or a draw to your investors. So you're not 100% going to say you're getting 21 cents back every year. But as you can see, because the balance sheet shows a little bit more shareholders' equity, you would hope, you would think that that number is going up as well. However, does someone want to go ahead and calculate, and I'll do it myself, what that looks like for 2019, which is this far right column?
Less.
Mm-hmm. Anybody got a number?
11%.
Yes. So in 2019, that number has now dropped to 11%. As we do in the case study within the 90-day MBA, the case study shows why you got to that number and how Vala Rock and Tile could improve that, where their cash flow situation is. But it's important to be able to calculate that year over year, because just like this, if 2017 is a point on a ruler by itself, you're not seeing which way it's trending. And so then by calculating 2018, 2019, you can see we're actually losing our return on investment every year. Not to say it's going negative, but it's going down. And so this is where, when I talk about setting goals, the objective is to know where you're tracking and be able to track towards that. And if you're not tracking towards that, at least being aware of it. And it's something that oftentimes we are putting out the fires of the daily hullabaloo that is the startup world. You're trying to do sales, you're trying to focus on this, but not focusing on pumping the name back in, the metrics that matter. You often can work yourself out of business. So some key takeaways. Current ratio. We're just going to focus on the three that we talked about. Like I said, 1.5 to 3% is a generally industry standard. It varies for every industry, but considered good. It indicates that they have short-term financial strength. And if this current ratio is, if the value of a current ratio is high, then the company may not be efficiently using its current assets. So if you're sitting on a ton of cash, maybe you have 1.5 million in the bank, you are potentially not using that. And so if this number is 10%, that doesn't necessarily mean it's a better thing. So I think that's why it's always important to have context for any of these numbers. So your short-term financing options like accounts receivable or the other places that your cash and cash equivalents exist just might not be used efficiently. So if this number is 5, 10, then how do you think about either paying that out to your shareholders, getting a return on investment, because you can still maintain a high current ratio and take that draw. So high current ratio is bad in its own right because it means you don't manage your working capital right. If the number is low, and specifically if this number is below 1, that means that the company has problems. And if that number is below 1, it means you're probably gonna have problems within the next year to pay off those current liabilities, whatever they may be, because you just do not have the liquidity that you need. And so that's where this number is kind of industry to industry. Certain people might like to have just more cash on hand, where certain people might not. And they'd say, hey, as an investor of this company, as a founder of this company who's worked my tail off for years, I think we should take a draw and we can still maintain a good current ratio. But that allows you to validate that. And I think that's one of the things that often for founders, you say, I don't know how to tell the investors I want to take some money out. I'm not making enough. This is the kind of number that allows you to validate that conversation. And so it's super important to be able to calculate these to be more informed. AR turnover and AR turn days. A high receivables turnover ratio may mean that the company's accounts receivables are super efficient and that the company has a high proportion of quality customers that pay quickly. If this number is high, that could be awesome. Because you're getting your money, and that's always positive. I will say the kind of other side of that is that if your number is too high, maybe you could offer better terms. You can still have a very industry acceptable AR turn days, but at the same time, now your customers are happier because they have better credit standing with you. Maybe it's something they work towards, but it's something that, again, the high number doesn't necessarily immediately mean it's better. It just needs to be calculated in the context. Low receivables means that you might not be effectively collecting from people, or that your credit policies are just not working well. So maybe you have a 90-day term. Can you bring that down to 60? It's hard to bring that down once you set a standard with a client. So maybe you start lower and say, we'll earn the way to 60, but we start at 30. And so after 6 months of paying on time, hey, I'm excited to let you know that we're extending your credit limit. Maybe that allows them to buy more. And if they're still paying on time, you'll give them that extra 30 days, but it's growing your business. And so a company's receivables it's just something that you should monitor. I mean, I think at the end of the day, it's a number that we forget about. We say, at the end of the day, we're going to get paid by who we get paid by. They'll pay us when they pay us. That's not a great mentality. You accept that there's going to be bad debt at some point. But within this, it's just important to track those trends and patterns, and how can you make decisions in the business that are going to affect those yourself. And then the last one is beware of averages. I think a good analogy that I use here is that there may be a lake, and that lake is 2 feet deep. You can walk around that whole lake and never worry about drowning. But in the middle of the lake, there is a hole that is 100 feet deep. If you step in that hole, you can drown. The average of the depth is still only 3 feet when most of it's 2 feet. So that's where these averages, you can be getting burnt by one big customer, even if that's not necessarily reflecting in this total number as your average on the turn days. And then finally, return on investment. This one's pretty easy to calculate. It's pretty easy to understand. And it's the number you'll hear over and over and over and over when people say, well, what's my ROI going to be? And it's a standardized number. So it's a universal measure of profitability. One disadvantage of the ROI number in the calculation we have is that it doesn't necessarily account for how long an investment is held. So to that point, a profitability measure that incorporates the holding period could be more useful for an investor. Your ROI might, so famously, where I live now in North Carolina, we have Research Triangle Park. And it is where a lot of biopharmaceutical companies exist, or secondary companies' headquarters are. Research Triangle Park has the second best return on invested capital in the entire United States, second only to Silicon Valley. That's a pretty staggering statistic for people to think. They think New York, Chicago, Los Angeles, Colorado. There's plenty of other places outside of Raleigh, North Carolina. Biopharmaceutical companies have a great return on investment, but they usually have to wait for FDA approval, which can take upwards of 10 to 15 years. So that's where this ROI, you need to take into consideration how long you're holding that money, that investment, before you're seeing that profitability, because it might be 15 years, but that percentage at that point could be a 10x return. Maybe you're not even around to collect on that. Maybe you've gone bankrupt and you can't wait 10 years. So that's where including a profitability measure is important when you talk about ROI. And that really wraps us up. I think the big thing is, are you going to track these? I will drop in the file. I will drop that file of these metrics into the chat here, or I'll have Lynn follow up with that. But as the CEO, as the founder, there's a reason this picture is good. This resonates with most of us as small business owners. We're sitting at our kitchen table or in the Preccelerator, trying to calculate this stuff, it doesn't necessarily need to be the accountant. It doesn't necessarily need to be the bookkeeper's job. But it also is something that I think is super important to share with others in your company. This is not information that should be held and kidnapped or held hostage just at the C-suite level. If your salespeople understand the accounts receivable days and how that makes a difference on the bottom line, they're going to understand if our goal is to reach a better AR turn days, how can I as a salesperson affect that number? Because what we're focused on is the net profit, not just revenues. And this is where I think educating every employee from the sweeper to the CEO of these numbers is hard. I think oftentimes we feel, well, not everyone needs to know how much cash we have on hand. Fine. Those things can be held a little bit closer to the chest. But understanding that these are metrics that the company should know, these are things that you can easily share without having to share the entire balance sheet, without having to share the entire income statement. Here are metrics that we're going to share with the entire employee base on our AR days. We're currently at 60. Our goal for the end of this quarter is to get that down to 59. And if we can shave one day off of this, everyone's going to get a little perk or a bonus or anything that's going to push everyone. You only can inform those numbers if you are informed of what they are. And so I think that that's my personal soapbox. Everyone should be more educated on this, not just the founders. And with that, that's the wrap up. I mean, at the end of the day, I hope this was helpful. I know that it's intimidating for most founders to say, I don't want to step on the CFO's shoes. You don't have to, but you need to know these numbers. They matter. They matter to your business. They matter to your success. If you're interested in the 90-day MBA, where we really dive into all of this and a slew of more stuff that I can't even begin to cover, check out goalmakers.com/preview. It'll give you a little sneak peek into the program. And if anyone wants to connect with me, here's my email, jeremy@goalmakers.com. To Preccelerator current companies, I'm always available as a mentor. To the mentors who are also on this call, feel free to give me a holler about your own company or just to learn more about what we're doing at GoalMakers. But I really appreciate the opportunity to share this knowledge. I come from the standpoint of this is stuff I wish I knew. These are the metrics that mattered in my first company that I didn't track, and I paid for it. And so it's easy to say, track them. It's easy to say, go figure this out. It's harder to do them than it is to just say that. But with that caveat, I'm happy to answer any questions if anyone has any, or if that's the end of this webinar and you got to go do real work, get after it, and I'll have Lynn circulate just that list of 15 of those simple ratios to anyone who wants it.
Thanks, Jeremy. Does anybody have any questions or comments? Let's see. No, you put that was you, Jeremy. I'm not seeing any questions. That means you covered it well. I actually learned a couple of things in this that I'm going to be able to employ in some of the organizations I help as treasurer. So that's a good thing.
Perfect.
It's a great insight as to what a founder needs and what I love, Jeremy, is you did not know this when you were running Luminous early on. And if you did, maybe it would have gone in a different direction because you would have had more information to make better decisions. And I think that's the takeaway. So great session today. Jason agrees with me. It's always good when Jason and I agree.
The one thing I'll add to this, and this is something that a friend of mine actually told me recently, and I've taken this to heart. He is a guy who played professional football, worked his tail off to get there. And he said one of his coaches when he was a kid said this, and it stuck with me. I don't want to be the smartest person in the room. I want to be the most informed. And that's one of those things that these metrics give you that. It lets you be more informed. And you can be as smart as you want, but if you don't understand these numbers, intelligence only matters so much. And so I think that's something that when I talk about these metrics and the financial literacy stuff, it's not about just being smarter about it. It's about understanding how do you actually use it. And so to that point, I really appreciate everyone. Jason, thank you for commenting. Paul, thank you for hopping in and sharing a bit more. Karen, I know that you said you made these mistakes in your past, and so happy to share the knowledge. And Megan, I'm sure you had a couple notes for me, so shoot me anything that I got wrong as someone who's more financially literate than I am. But I really appreciate the opportunity, and if anyone wants to connect, Jeremy at GoalMakers.com.